Welcome to CoreLogic's update on housing market conditions for August 2018. Last month we saw our national index move through the 10th straight month of falling home values. Since peaking in September last year, the Australian housing market has recorded a cumulative 1.9% fall in value, a relatively mild downturn to date, especially when you consider that values remain 31% higher than they were 5 years ago. The month of July saw the housing downturn gathering some momentum though. On a national basis, the 0.6% month-on-month fall was the largest decline since September 2011, and the rolling quarterly change at 0.9% hasn't been this low since January 2012. 5 of the 8 capital cities saw values slip lower over the past 3 months, and trends across the regional housing markets where conditions have generally been more resilient to falls have also turned negative. The weakness in dwelling values is being driven by the long-running declines in Perth and Darwin, along with an acceleration in the rate of decline across Sydney and Melbourne. Outside of these cities, growth rates are generally slowing as tighter credit conditions broadly dampen housing market activity. Across the capital cities, Melbourne has been leading the downturn, with the quarterly rate of decline outpacing Sydney since May this year. Melbourne dwelling values were down 1.8% over the past 3 months, followed by Perth, which was down 1.5%, and Sydney, where the market was down 1.1%. Melbourne's decline phase commenced 5 months later than Sydney's, with the market peaking in November last year. Since that time, Melbourne dwelling values have fallen by 2.9%, while in Sydney, where values peaked 12 months ago, the market's down 5.4%. Those cities where values continue to trend higher have also seen a sharp reduction in the rate of capital gain. In Brisbane and Adelaide, where housing values are rising at a more sustainable pace over the last 5 years, the annual rate of capital gains has weakened. In Brisbane, the annual rate of growth has eased from 2.9% a year ago to 1.2% over the past 12 months, and in Adelaide, the annual growth rate has dropped from 5.4% a year ago to just 0.7% over the most recent 12-month period. Even the Hobart market, where the annual pace of capital gains has held in double-digit growth territory since January 2017, is starting to slow down. Dwelling values were steady over the month, and the annual rate of growth slowed to 11.5%. Still strong, but the slowest annual growth rate since February 2017. Over the past 3 months, Hobart dwelling values have increased by just 1.1%, which is their slowest rate of increase over a 3-month period since July 2016. Focusing on the regional markets, dwelling values were down 0.2% across the combined regionals index over the 3 months ending July, driven by falls across regional New South Wales, where the market was 0.2% lower. Values were also down 0.6% across regional Queensland and regional WA, which recorded the largest decline over the quarter, down 3.5%. While 3 of the 7 rest of state regions saw a fall in values over the 3-month period, the pace of growth across the remaining regional areas has clearly decelerated, contributing to the overall softer national result. Settled sales numbers highlight the market weakness, with the number of dwelling sales falling by almost 10% over the 12 months ending July 2018. Every capital city, apart from Adelaide, has seen a reduction in the number of settled sales, with the largest annual declines recorded in Sydney and Melbourne, where the sales over the past 12 months were down 17% and 15% respectively. As activity in the market slows, inventory levels have risen and vendors have lost some leverage. Total advertised stock levels are almost 8% higher than a year ago, reaching the highest level for this time of the year since 2012. With more properties to choose from, buyers are negotiating harder, resulting in higher vendor discounting rates and longer selling times for private treaty sales. Of course, conditions are very different from city to city and across the regions. Melbourne's downturn accelerated in July, with dwelling values falling by almost 1% over the month to be 1.8% lower over the past 3 months, the largest quarterly decline amongst the capitals and the most significant drop in value since January 2012. Since peaking in November last year, Melbourne house values are down 3.7%, while the unit market has seen values trending lower only since April of this year and are down 1.1%. There has been some material divergence in growth rates between higher priced properties and the lower end of the market, with Melbourne's top quartile values falling by 4.1% over the past 12 months, while the least expensive quarter of the market is up 7.5%. The stronger growth conditions across the more affordable end of the market can be attributed to first home buyers propping up demand, as well as borrowing capacity for more expensive properties being impacted by tighter debt-to-income ratios from lenders. Overall, we can't see any factors that may halt or reverse the housing market's trajectory of subtle declines over the second half of 2018. The availability of housing credit has been a significant factor contributing to the slowdown. However, there are a variety of hurdles contributing to slower conditions. From a credit perspective, the latest credit aggregates from the Reserve Bank of Australia highlight that owner-occupier lending has continued to grow at a relatively strong pace, up almost 8% over the 12 months to June. The same data highlights that the slowdown in credit growth is attributable almost entirely to less investment lending, where growth is tracking at a record low of 1.6% annually. Sydney and Melbourne have recorded the most substantial concentration of investment activity, and despite the tighter lending conditions for this segment and weaker housing market conditions in Sydney and Melbourne, somewhat surprisingly, New South Wales and Victoria continue to show high levels of investment concentrations relative to other states. Although the 10% speed limit on investment credit growth has been removed for eligible lenders, we aren't expecting to see a rebound in credit availability for investment purposes. Mortgage rate premiums for investment loans remain in place, and the limits on interest-only lending continue to provide disincentives to housing market investment. Additionally, market factors such as low rental yields and dim prospects for short-term to medium-term capital gains are also likely to quell investment demand. Higher housing supply is another factor that's likely to weigh on some sectors of the market. Unit construction remains well above average across most states and is at record highs across Victoria and South Australia, and only marginally below the record highs in New South Wales. Coupled with high supply, key segments of demand, including domestic investors and foreign buyers, have thinned out, which could see some downwards pressure on prices, particularly in those areas where new investment-grade projects are numerous. Migration trends have also changed, which is likely to have both a positive and a negative impact on housing market demand. Although the Australian Bureau of Statistics demographic data is only current to December last year, it's clear that New South Wales is seeing a growing exodus of residents to other states, while interstate migration rates into Victoria appear to have peaked as well. The reduction in migration implies reduced housing demand in these locations. Queensland is the major beneficiary of cross-border resident flows, which should help to support housing demand, especially across the southeast corner of the state. Despite the reduction in dwelling values in Sydney and Melbourne, housing affordability remains a pressing issue in these cities. The ratio of dwelling prices to incomes was tracking at 9.1 in Sydney and 8.1 in Melbourne at the end of June. Although these ratios are likely to improve as incomes edge higher and as housing prices reduce, prices would need to fall a lot further to see this measure of affordability return to more adequate levels, especially when you consider where these ratios are relative to the other capital cities. While dampening factors are clearly at play, consistently low mortgage rates will continue to provide a support buffer, which should help to keep a floor under housing demand. Owner-occupiers continue to enjoy mortgage rates at the lowest level since the 1960s, and although investors are paying about a 60 basis point premium on their home loans, interest rates remain low for this segment of the marketplace as well. Higher funding costs could see mortgage rates edge a little bit higher. However, we would need to see mortgage rates rise by more than 150 basis points before returning to the 20-year average of 6.8%. Even though smaller lenders have increased owner-occupier mortgage rates, some larger lenders have recently reduced interest rates for certain owner-occupier mortgages. Considering the 30% limit on interest-only loan originations and the stiff interest rate premiums for interest-only loans, it's likely we'll see more owner-occupiers gradually consume a greater share of market activity relative to investors going forward. With the housing market changing rapidly, it's becoming even more important to stay across the trends as well as the key economic and demographic factors at play. The CoreLogic research pages are maintained with a frequent update schedule on the key issues. Stay up to date at www.corelogic.com.au.